All right, welcome to this explainer. Think of me as your lead investigator today, because we're pulling back the curtain on exactly how the pros value utility stocks. We're putting one gas, ticker symbol OGS, right under the microscope. We're not just looking at a stock chart and crossing our fingers here. Oh no, we're diving into the hard data to conduct a rigorous professional-grade equity analysis to calculate this company's true intrinsic value. So grab your notes, because we're building a comprehensive valuation case file from scratch.
Okay, here's the game plan for this case file. We'll start with the target profile, then move through absolute valuation cash models, the residual income model, relative valuation, asset-based valuation, and finally, we'll synthesize it all to get our final intrinsic value.
Section 1. The target. Let's look at the one gas profile.
Before we even attempt to value a business, we have to know its current footprint in the market. And here's the central mystery we're trying to solve today. One gas is currently trading at exactly $88.91 a share. But you know the old saying, right? Price is what you pay, value is what you get. The market is basically telling us the stock is worth about $89 right now. Our job, figuring out if its actual intrinsic value actually matches that price tag.
So let's look at our initial clues. We've got a steady dividend payer here with a $5.58 billion market cap. They're offering a pretty solid 3.06% current dividend yield, backed by an impressive 12 consecutive years of dividend increases. That's a huge neon sign showing their commitment to returning capital to shareholders. But wait, there's a catch. Look at the trailing 12 months. They have a negative free cash flow of over $128 million. That's a massive clue, and it's absolutely going to dictate which valuation models we can actually use today.
Section 2. Absolute Valuation. Let's dive into the cash models.
Now, absolute valuation is all about finding a company's worth based strictly on its own fundamentals. We completely ignore what the rest of the market is doing. And because one gas has that 12-year streak of dividend increases, the dividend discount model, or DDM, is by far our most reliable tool here. The logic is beautifully simple. If you buy a stock purely for the cash it pays you, well, the stock is worth the sum of all those future dividends, discounted back to today's dollars. For a regulated utility with highly predictable dividends, it's a perfect fit.
Let's actually run the numbers. Step 1. We take that $88.91 price and the 3.06% yield, which gives us an annual dividend of roughly $2.72 per share. Step 2. Since the source data doesn't explicitly give us a discount rate, standard professional practice for a stable utility means we assume a sensible cost of equity. We're going to use 7%. Step 3. We apply their 5-year dividend compound annual growth rate, which is 3.23%. You plug all that into the Gordon growth formula, and the math points to an intrinsic value clustered somewhere in the mid to high $70 range. Right away, you can see that's notably below the current $89 market price.
This is exactly where we have to be adaptable. Normally, we'd absolutely run a discounted cash flow, or DCF model, right here. But the traditional DCF, it breaks down entirely for one gas. Remember that negative $128 million in free cash flow? You just cannot confidently discount cash flows when the current baseline is bleeding that much red. Plus, their price-to-free cash flow ratio is sitting at a staggering negative 42.09. Trying to project positive cash flows off that would require some wildly aggressive, honestly speculative assumptions. That violates every rule of conservative equity analysis. So we scrap the DCF and lean heavily on our other models.
Section 3. The residual income model. Accounting for equity charges.
So we pivot. The residual income model is basically our secret weapon when cash flows are messy or, totally negative like we just uncovered. To run this, we first need the company's book value, essentially what its net assets are worth on paper. Since the source filings don't explicitly hand us the book value per share, we just reverse engineer it. We take the $88.91 current stock price, divided by their price-to-book ratio of 1.62, and boom, we deduce an implied book value per share of $54.88. That forms the foundational baseline of our target.
What's super fascinating about how the residual income model operates is this. It essentially says, all right, you've got $54.88 in book value. But what actual value are you creating with those assets? One gas generates a 7.68% return on equity. So the model calculates the value they're creating beyond just the raw assets. It looks at the earnings generated by that ROE and subtracts an equity charge, which is just the baseline return investors demand. It's like measuring the extra value they bring to the table.
When you factor in all those exact earnings dynamics, the source data explicitly calculates an earnings per share fair value of exactly $66.81. That number right there represents the present value of the book equity plus the present value of all expected future residual income. It's a remarkably sturdy, reliable calculation. And best of all, it completely sidesteps that negative free cash flow nightmare that totally ruined our DCF attempt.
Section 4. Relative Valuation. Comparing to historical multiples.
All right, our absolute models are built. Let's look outward at relative valuation. Usually, we'd compare one gas to its publicly traded utility peers. But since our source data doesn't list specific competitors, we're going to use one gas's own historical averages as our baseline. We're comparing the company today against itself over the last 3 to 5 years. Look at the trailing price-to-earnings ratio. Right now, it's trading at 20.35, but its 3-year average PE is only 18.16. That means if you buy today, you are paying a roughly 12% premium for a single dollar of their earnings compared to what investors normally pay. Even the forward PE, which is 19.05, still shows an elevated price.
And we're seeing the exact same story playing out with the enterprise value to EBITDA ratio. Now, this metric looks at the entire value of the company, debt included. That is absolutely crucial for a capital-intensive utility that carries a debt-to-equity ratio of 0.98. The current EV to EBITDA sits at 11.18. Again, that's over 5% higher than its 3-year historical norm of 10.62.
So, what's the big takeaway from our relative valuation? The market is broadly pricing this stock higher than its historical norms. Period. The price-to-sales ratio is currently 20% higher than its 3-year average, and price-to-book is 8% higher. Honestly, no matter which specific multiple we look at, the models are all screaming the same thing. The stock is currently overvalued compared to its own historical baseline.
Section 5. Asset-based valuation. Calculating net asset value.
Next up, we're stripping this company down to its studs. Asset-based valuation essentially asks, what would this company be worth if we literally sold off every pipeline, every facility, liquidated the assets today, and paid off all the debt? For a pretty straightforward utility without a bunch of complex, hidden, off-balance sheet tricks, the net asset value per share is going to closely mirror that implied book value we found earlier. That's $54.88. Think of this as the absolute floor value of the company, the raw, tangible worth of the assets themselves.
But I have to point out a major flaw if you rely entirely on this asset-based model. It is incredibly overly conservative. One gas isn't just a pile of pipes. It's a living, breathing utility that actively generates returns. Remember that 7.68% return on equity and a 3.08% return on assets? A strict net asset value totally ignores that compounding engine. It values the business as if it were dead, not a functioning operation. So $54.88 is a great baseline to know, but it definitely understates the true operating value of the business.
Section 6. Final intrinsic value synthesis. Let's get to the verdict.
Okay, we've gathered the clues from the absolute, relative, and asset-based models. Let's wrap up this investigation. Look at how the data summarizes. Our most reliable models cluster the intrinsic value neatly below the current market price. The dividend discount model gave us a value in the mid-70s. The earnings and residual income value points explicitly to $66.81. Our strict asset-based floor is $54.88, and the relative multiples all confirm the stock is historically overvalued. Are you noticing a pattern here? Literally not a single rigorous model justifies that $88.91 market price. When we carefully weigh everything, and keeping in mind we had to completely toss the DCF model because of those negative cash flows, our single most robust and reliable intrinsic value estimate comes from the residual earnings model. The source concludes the fair value sits right at $66.81. So what does that mean for you? It means an investor buying today at $88.91 faces a negative 33.07% margin of safety. Let me repeat that, a negative 33% margin of safety. There is zero room for error, and you'd be paying significantly more than what the underlying financial math says the company is actually worth. In the value investing world, that is a massive, glaring warning sign. So I'm going to leave you with this final provocative thought. We absolutely know One Gas is a fundamentally stable utility. They have 12 straight years of dividend increases, which is fantastic. But even with that pristine track record, is paying nearly $89 for roughly $67 of intrinsic value, a premium you are actually willing to accept. It is a textbook case of a good company trading at a potentially very bad price. Thanks for walking through this analyst case file with me, and I'll catch you in the next explainer.